Hello students, this is Professor Vincent Osaya. Welcome to my class, and this is part 5 of chapter 15 presentation, Stockholders Equity. At this point, we are going to talk about how to account for and report preferred stock. Now, we discussed previously some of the characteristics of a preferred stock, and here are additional characteristics. So if you buy a preferred stock versus common stock of a corporation, you have some preferences over common stockholders. Now, some of the preferences are: preferred stockholders receive dividends before common stockholders. In the event of liquidation, if the company goes belly up, preferred stockholders get a piece of whatever is left before common stockholders. Sometimes you are able to convert your preferred stock to common stock, and the company is able to call the preferred stock and buy them back at the options. Preferred stock, another important thing that you need to know, is non-voting. So if you have a preferred stock, you cannot vote. Now, here are some features of preferred stock. So companies issue preferred stock, and preferred stock comes in different shapes and sizes. Okay. Now, some companies will issue a preferred stock, and the preferred stock will have one or more than one of these features. Number one, cumulative. What does that mean? That simply means if the corporation is not able to pay the dividend in a particular year, the dividend that they are not able to pay carries over. So the company has to pay dividend in arrears whenever they are able to pay dividends. Participating, meaning if you buy a preferred stock that has a participating feature, meaning after you pay the preferred stockholders first, then you pay the common stockholders. And you pay the common stockholders in commensurate to what the preferred stockholders actually receive. Then whatever is left, the preferred stockholders cannot participate or take additional entitled to additional piece of whatever is left. Then we also have convertible preferred stock, meaning that's a preferred stock that can be converted to common stock. We have callable, meaning the company can call or buy back the preferred stock. Then we have redeemable preferred stock. So that is a preferred stock that can be redeemed by the corporation as well. So a corporation may attach, again, like I said, one or more than one of these features in its preferred stock. So moving along, let's take a look at how we account for preferred stock. The accounting treatment, or how we record preferred stock issuance or sales of preferred stock, pretty much same with common stock. So this example, the company issues 10,000 shares of preferred stock. This is a par value preferred stock for $12 cash per share. So the company records the issuance as follows. They receive $120,000 cash. Again, preferred stock is credited based on the number of shares issued multiplied by par value. All right. So 10,000 multiplied by $10, that gives you 100,000. So the difference is credited to paid-in capital in excess of par. So moving along, let's take a look at the policies that companies use in distributing dividends. So here, let's talk about the dividend policy. We said that few companies pay dividends in amounts equal to their legally available retained earnings. Why? So let's back up. What are retained earnings? Like we discussed earlier, a companies make profit. We call it a net profit. We sometimes call it net income. We also sometimes call it earnings. The same thing. These words are used interchangeably. So whatever profit that the company decided to keep, whatever profit that the company gives to the owners of the company, of course, the owners or the stockholders have ownership to the profit or the net income of the corporation. So when you take a piece of that net income or profit to the owners and you distribute it to them, we give it a fancy name and we call it a dividend. Whatever is left or whatever is not given to them, like we said, we call them retained earnings. So Why would a company retain some of the profit or some of the earnings of the company? Here are different reasons. Number one, to maintain agreement with creditors. You borrow $10 million from the bank, and the bank said, until you pay off the $10 million, you are not able to pay more than XYZ amount to your shareholders in form of dividends. Or your dividends should not have less than $35 million in the balance. So you are not being restricted as to how much dividends you can pay to the owners of the company. So you can go through these examples or these reasons for yourself. The last one, to build up a cushion against possible losses. You want to keep as much cash as possible. And second to the last, to smooth out dividends payment. Companies want to be consistent in paying dividends, and they want to make sure that the dividends payment actually is consistent the way they pay it across the board, instead of paying dividends in some years and not being able to pay dividends in subsequent years. So moving along, let's take a look at various forms of dividend distributions. So here we are talking about types of dividends. Okay, so the company pays dividends in different ways. The number one, or the most common way of paying shareholders dividends is through cash. So we call that cash dividend. But then there's another way of paying stockholders dividend by way of giving them property. What property? It could be the company's investment in other companies' stocks or bonds. It could be, for crying out loud, furniture or automobile or equipment, if the shareholders are willing to take some of those assets instead of cash. So we call that property dividends. Number three, we call it liquidating dividends. We are going to talk more about that in a minute. And number four, we have stock dividends. So we said that this rule is very important for you to know. All dividends except for stock dividends reduce the total stockholders' equity in the corporation. Okay, so we are going to take a look at how that plays out in a minute. So let's take a look at the first type of dividend, cash dividends. So the board of directors vote on the declaration of cash dividends, meaning on a particular day, the board of directors make a public proclamation and say, we are going to pay dividend of 50 cents per share to shareholders. So that we call the date of declaration. Again, right here we say there are three important dates relative to cash dividend. Number one, date of declaration, the date the board of directors make public announcement that they are going to pay dividend. When that happens for cash dividend, the corporation is legally obligated to pay that dividend when the announcement is made. If the announcement is not made, the corporation is not legally obligated. But when they open their mouth and make a public declaration that they are paying dividends, a liability is incurred, and we have to record it. So then another date of record, another important date. So that is the date any shareholder that has a position or have a possession or ownership of the company stock at so particular date after the date of declaration is entitled to receive the dividend. And of course, date of payment is the day that the company actually made the payment. Okay, now another important rule that you need to know here, we said that companies do not declare or pay cash dividends on treasury stock. Why are they not paying dividends on treasury stock? Again, the company cannot trade between itself. All right. So moving along, let's take a look at an illustration here. Here, the company declared a cash dividend of 50 cents a share on 1.8 million shares payable July 16 to all stockholders of record June 24. So the date of record is June 24. So on declaration date, which is June 30th, right there, an obligation is the company is legally obligated to pay. So look at the journal entry that we have here. We credit dividend payable for $900,000. We debit retained earnings for $900,000. Remember, retained earnings is the second part of stockholders' equity section of the balance sheet. The normal balance for retained earnings is credit. When we debit retained earnings, what happens to retained earnings? We decrease retained earnings. When retained earnings goes down, the stockholders' equity section of the balance sheet as a whole also goes down or it decreases. So that is something I said I was going to bring to your attention. And of course, dividend payable, that's a liability that has to be reported under the current, as a current liability. Now, moving along, at the date of record, there's no entry. And we talk about the date of record. So anyone that has the company stock at that day is entitled to receive that dividend. So at date of payment, which is July 16, we actually make the payment and cough out $900,000 cash and debit dividend payable for $900,000. Of course, we credit cash for $900,000. So moving along, let's take a look at the property dividends. So here we are paying dividends in form of using non-cash asset, another type of asset but not cash. Now, how does that work? Take a look at the rules that you need to know relative to property dividend. The first thing you need to know is the fair market value of the property has to be restated, okay? Then we have to recognize the gain or the loss. Now, what does that mean? Let's take a look at an illustration. So this company transferred to their stockholders equity investment costing $1.2 million. What does that mean? So this company has stock of another company that they purchased as investment. This is not their own stock now. This is stock of another company that they purchased in form of investment. Now they decided to distribute that stock or that investment as dividend. It cost them $1.25 million, okay, to be distributed on January 30, 2014 to stockholders of record on January 15, 2014. However, on the date of declaration, the fair market value of that investment was $2 million. It cost them $1.25 million. So the first thing we need to do is to restate the fair market value of the stock. So the equity investment account, which has a debit balance of $1.25 million, we need to debit it by additional $750,000, okay, because we are restating it. Then we credit unrealized holding gain or loss. This has to be reported for $750,000. So these are reported as well. Now, it is important for you to know here that we call this unrealized holding gain because the gain actually has not been realized, meaning we actually have not sold it. You have to give me a minute. So, moving along, after restating the fair market value of the investment or the equity investment account, we now debit retained earnings for $2 million and credit property dividend payable for $2 million. Again, actually we are giving up $2 million, not $1.25 million, because the fair market value of the investment that we are giving up is worth $2 million. So, date of distribution, when we actually distribute the equity investment or the stock of another company that we have, we debit a property dividends payable and we credit equity investment account for $2 million to get rid of that account. So moving along, let's take a look at liquidating dividends. Now, what does that mean? Here we say that any dividend not based on retained earnings reduces corporate paid-in capital. What does that mean? If the retained earnings balance is $1 million, the company technically has up to $1 million available to distribute to the owners of the company as dividends. All right? I think this would be a good point to wrap up part 5 of this presentation. Hopefully, we should be able to wrap up the whole chapter in the next part.